Welcome to FinScale, a podcast created by Solen Niederkorn, shedding light on innovation in finance, banking, and insurance.
SaaS, a comprehensive look with a veteran investor. Hillel Zidel, Managing Director at Kennet Partners.
We leverage technology to collect data on hundreds of thousands of companies. We use analytics and algorithms to determine which of these companies are the most interesting, and we focus on proactively outreaching to those companies. And technology has played a part, throughout the journey in this. And, we're now using AI, we're using generative AI to do this. And I think what we've seen is this has really given us quite a good bump in efficiency.
I've been discussing SaaS on the podcast for years. In his renowned article, Why Software is Eating the World, Marc Andreessen explained that the software would take over large portions of the economy, driven by the proliferation and success of the SaaS model. This model has shifted us from physical and localized systems to global, scalable, and efficient software solutions. 13 years after these insights, what do we think about SaaS? It's a topic I've been eager to explore with an expert. Hillel, who has years of experience investing in B2B SaaS, joined me for this discussion. We covered many topics, including the evolution of pricing models, the value proposition, the transformation of incumbents, the shift to cloud-based services, and more recently, topics related to AI. This was an opportunity for me to introduce you to Kennet, whom I know well. We discussed the funds, the thesis, and certain investments such as Eloomi, which have exited. These investments allows us to talk about KPIs and the role of sustainable growth in investment decisions. Enjoy the show. Hello, everyone. Hi, Hillel.
Hi, Solen. Great to talk to you.
Yeah, I'm very happy to have you on the podcast to talk about software as a service, to talk about Kennet. Prior to that, can I ask you to quickly introduce yourself and tell a bit about your background and your way to and your path to Kennet Partners?
Yeah, absolutely. So I'm a managing director at Kennet Partners. We are a growth equity fund focused on investing pretty much exclusively in business-to-business software companies that have been bootstrapped. Prior to Kennet, I was actually working with growth companies on the debt side as a lender to high growth companies, providing loans with equity warrants. In my earlier career, I worked in management consulting, and then right at the beginning, actually worked at a few B2B tech startups, and that's where I first got really interested in the world of B2B technology. And I'm originally from South Africa.
Okay, so Hillel, I invited you on the podcast because some people listening to us know a board member in your Lux entities, so I know quite well Kennet Partners, and I find that you have an interesting play in software as a service. This is a topic that I've been diving into with a former guest on my French channel called Nicolas Collin. We had an interesting discussion, the two of us, not about the family, about the way he was envisaging the evolution of VC. Considering that you have been investing for years now in a SaaS model, I wanted to start with this and focus on that specifically. How has the software as a service model changed its core structure and delivery mechanisms since its inception, when you think like 15 or 20 years ago?
Sure. So, yeah, we've been investing in software for sort of north of 20 years or so. And obviously, you've seen a lot of changes in the category. I mean, in the early days of software investing, it was very much investing in businesses that sold through a license-based model, which meant you would go out and your customer would pay you a big upfront license, and then there'd maybe be some services, and then they'd pay you 15 or 20% maintenance as long as they use the service. And the customer would really buy and own the service, and it would be located within the customer's premise. Similar to when you buy Office CD, and it's sort of on your local machine. And a number of software companies did well in that area, and we had a number of successes in the category. Around the sort of early 2000s, the model started to move to software as a service. And so, this had a number of really impactful changes on the category. firstly, rather than the customer owning the software, they're essentially licensing it. So instead of paying, $1 million up front and then $200K per annum, they'd be paying a recurring subscription every year, essentially licensing the software. And then the second aspect is the delivery mechanism. Rather than the customer owning and hosting it, the service would be hosted in the cloud. And from a company perspective, this is just much more scalable, much more configurable. I think what's really interesting from an investment perspective is, software investing used to be a lot more risky than it is these days, because it was very much dependent on how successfully your sales were in that month, that quarter, that year. What SaaS did is it introduced this really nice recurring revenue model. So you have a base of annual recurring revenue in the same way that a bank or an insurance company may have an annuity income stream, and then you're adding to that every quarter. And what this means is you're really stabilizing your revenue much more than it was under a license model. And I think this coincides with a huge amount of private equity investment into the software market, because this was previously seen as a bit risky on the tech side, and then investors understood that actually this is much more predictable and safe and more akin to a typical private equity type investment. So I think that's probably the main change, the main shift in software, the movement from on-premise to recurring revenue SaaS. And then that SaaS itself has evolved a lot, with APIs, software solutions, talking to each other in an integrated way. Obviously, the advent, mobile, has had a big impact on the SaaS market, where a number of areas, clients are accessing their solutions via the mobile device. So integrations, security, compliance, and what have you. And I think I'm sure we'll talk more about AI, but I think we're at kind of the next big change in the tech market, impacting SaaS and other areas, which is AI.
Yes, it's very interesting. It's more or less aligned with what Nicolas was telling me. Interesting. In what ways do you think that the expansion of this model influenced traditional industries? So I'm thinking, of course, of more finance sector, because this is the one I know the most. And those players were really slow incorporating even cloud technologies, and now they are keen on using software as a service. So do you think that they have integrated the model also in the way they approach their own clients?
So what we've seen over the last few years is the rollout of SaaS solutions across multiple industries. And some industries have been much quicker to adopt software solutions than others. I think, I read a stat a few years ago, something like 15-20% of markets had been penetrated by software, and that was great. So I think there's still a lot of open space. I think you mentioned banking and financial services. This is an interesting one, and I think in some areas, particularly on the smaller side of the fintech side, there's been a very significant adoption of SaaS. Within banking, this has been slower and taken much longer because of large legacy solutions within banks that have been put together through multiple acquisitions. But I think from a customer perspective, the ability to leverage software within your mobile banking apps, within your investment management apps, and what have you, has been hugely beneficial. But I think our view is that there's a long way to go in terms of kind of the SaaSification of industries. We see within the ultimate customer base, banks, insurance, healthcare, what have you. There's a lot of areas, a lot of divisions that still need to take on SaaS solutions, which makes us very excited about the next kind of 5 to 10 years of investing in SaaS companies selling to these industries.
I read a few weeks ago a blog I read written by Thomas Tongons. I don't know if I pronounce his name correctly. This VC guy.
Sure.
He was writing something about regulation, telling that, builders don't take care about regulation and all those concerns and data privacy. I don't agree with this, and particularly in fintech, this is a major concern, not only in Europe, but across the globe. With all those growing concerns about data privacy and regulation, how do you think that software as a service solution have been influenced also in the way they scale their businesses worldwide? And do you agree with Thomas, or do you think that it's, as me, a concern that is absolutely critical for builders in that area?
It depends on, what the product is and what the client is. So, where you're selling solutions to individuals, which are nice to have, not mission critical, security and compliance is obviously important. GDPR. When you're selling to large institutions, it's absolutely critical. So, what we typically see happening is the business unit sponsor wants to buy the product, and then it goes through a procurement process, and there's a long period of evaluating the security. So it's not a nice to have, it's not optional, it's really table stakes to be selling, solutions to corporate customers. The more value that can be delivered, by a company, means that they need access to more data, more information, and your clients need to feel absolutely comfortable that you've got the best security and compliance practices in place. So I think that historically it was an inhibitor to companies taking on software solutions because they were worried about it. Today, most vendors see this as really critical to their ability to sell and deliver, meaningful software solutions. And I think it will only become, more and more relevant as more data, gets inputted into these solutions.
Interesting. There is one topic that you mentioned is artificial intelligence. So there is a lot of noise around this and all those technologies, those last months in particular. How do you see SaaS evolving, bearing in mind that they need absolutely, and all of them more or less, integrate all those technologies within the solution? And what will be the impact for the customers of those solutions? Do you see already some trends?
Yeah, I mean, it's definitely the market is evolving. We've been investing in AI-based companies for a long time now. Probably 2014, 15 was when we started. So I think what we're seeing in AI is this is really kind of a step change in AI capabilities, but AI is not new. I think there's a lot of noise in the market. There's a lot of hype in the market. Some of it it's very real, and other aspects of it, I think are maybe kind of less real. But from if you're a B2B SaaS company today, I think every business needs to be looking at how they can leverage AI as an opportunity, and what are the threats and the risks that AI pose to their business. I think customers really care about customer value. I don't think an AI solution is in itself interesting to a customer if it's going to deliver something that they could get through a traditional solution. So I think every single B2B SaaS company needs to have an AI roadmap. We're starting to see customers asking for it. Again, it's not that the customer needs the AI solution for what they're doing today, but they want to know that the vendor that they're signing for a long-term period, has a clear plan of how they're going to leverage and implement AI going forward.
Okay. Good. Interesting. I mean, it's more aligned with what I read and what I see, but it's great to hear it from you. Can you say a few words about the launch of Kennet Partners? Because it's been a player since now many, many years. And when I talk about Kennet to VC, everyone knows you. So yeah, a little bit about the history and the investment thesis for the audience and those who don't know you.
Yeah, absolutely. So we've been investing, since 1997. We've focused purely on growth capital, since about 2007. And, we have a very, very focused strategy. So the strategy is B2B software only, and then in companies that have been bootstrapped or built in a capital efficient way. So, what bootstrap means to us is a business that has been built to scale without reliance on external capital. This is very different to traditional venture capital companies that, may have raised a bunch of money, have burnt that money, now raising again. The typical company that, we love investing in has got to, 5, 10, 20 million in annual recurring revenues. Probably hasn't raised any money, or if they have, it's a very small amount from friends and family. And we partner with these companies to support on the expansion, to the next stage. So we typically work with, companies in 3 ways. The first is supporting a bootstrap founder in building a world-class management team. So this means second-level management team, board level managers. And we're introducing people who've done it before in a capital efficient way. Secondly, international expansion. One of the key reasons that companies choose to work with us is because we can support them in their international aspirations, particularly to the US market, where we have a team. And then finally, we support companies on what we think of as their strategic value. So this may be developing channel partnerships. This may be bolt-on acquisition strategies. This may be consolidating the industry. And I think interestingly, these are companies that typically don't need money. They're not burning capital, running out of capital, but they have an option to further accelerate, increase the development and the growth. And certainly in Europe, we're probably the only group exclusively focused on this category of bootstrap, highly capital efficient, high growth B2B SaaS companies.
Mm-hmm. And how many funds did you raise?
We're very fortunate to be investing our 6th fund at the moment.
The Kennet 6, yes. And there is an interesting relationship you have built with Edmond Rothschild. Can you say a few words about this? Because I find it interesting.
Yeah, so we've known Johnny and Edmond Rothschild since probably about 2018 or so. Important to say, we're an independent firm and we've been operating, for a long time independently. And our relationship with EDR is such that, as you mentioned, they're a very important investor in the fund. But we see them as a strategic investor in that, in addition to their own investment, they support us on the fundraising side. So through their private bank and asset management arm, have supported in raising, significant, sums of capital from a very complementary LP base, to our own LP base, and support on some of the administration side. We've worked with them from Kennet 5 and into Kennet 6. It's been a great relationship, great partnership, it's something that we see as really, really interesting and valuable.
Okay, so you didn't really talk about your investments. I wanted you to maybe take a few of them and explain to us the reason why you invested. And also interesting, in parallel to that, explain to us also the nature of the KPIs that you were initially following for those companies and that you needed to adapt because the KPIs, as you said, evolve over the time because the SaaS model completely changed over the last 15 years. That could be interesting to take one of few examples and illustrate the KPIs that you initially prioritized and now the one that you decide to follow?
Sure. So maybe we had an exit a couple of months ago of Kennet, one of our earlier portfolio companies called Eloomi. So maybe I'll talk about that because that is kind of a recent example of something we worked on. So Eloomi is a business started in Denmark in the learning and performance management category. The company had done really well in the local market, providing a solution which was really focused on learning within mid-market companies. We met Klaus, the founder, and the team in London in about 2019 or so, and their aspiration was really to expand. They didn't need capital. They had a healthy balance sheet. They had a very good product, and they wanted to expand internationally. And so, what we liked about this company was firstly, strong team. The CEO Klaus had built a company previously in a very different category, but had real business experience. It's a solution that serves multiple industries, but with a very clear customer value proposition. And so we invested in the business. I think total investment of about 15 million euros. And we did three things with the company. The first was helping them build a team. So we brought on board Pete Daffin as chairman. Pete is a multiple-time CEO, experienced chairman, real business builder. We helped support in the development of the second level management team around Klaus, the founder. Then international expansion was key. So we initially supported them in their UK expansion, which was an area where they were getting good traction, and then ultimately supported in developing the US market, where the team actually moved to. We brought in a chairman, supported an external follow-on funding to roll out the US development, and then supported on channel partnerships. The company grew probably 5 times, just under 5 times over our holding period. And then we sold the business to Ceridian, which is a US-based, about a 10 billion market cap HR software company, making a very attractive return for our investors. And this is sort of a classic case of what we like doing, investing in a company that's got a great product, good customer base, and we can support in helping to scale these companies out. And we've been very active this year. We've done 2 more new investments in similar types of stories. High growth, capital efficient / or bootstrap companies, great product, customers really like them, and looking for a partner to support on the international expansion and supporting on just creating a really strategic and valuable asset.
But in terms of KPIs, what are the top 3 KPIs that you have in mind when you meet them? And again, maybe going back to earlier deals, do you keep the same KPIs than 15 years ago?
Yeah, great. So, I think the key things we're looking at firstly is growth. We want to invest in companies that have revenue growth of, our minimum is 30%, but ideally higher, 40, 50, 70, 80%. The second is capital efficiency. So, we don't invest in companies that have to burn a lot of capital to get to the point where we're investing. So typically these companies, they may be profitable, they may break even. If they are losing money, it's a small amount. So that efficiency is really important to us. And then probably the third metric I'd say is retention. So our focus is on mission critical or essential products and services. And so if a customer is purchasing your software and every 6 months, 12 months, you're losing customers, that churn, we see as problematic. So there's lots of ways to measure retention, but ultimately this is, do the customers buy the service and continue to use it without churning? The things that I'll tell you, the things that are sort of red flags for us when we're looking at businesses. I'd say the first one is customer concentration. So we're very, very skeptical if you've got 1 or 2 customers that account for a very large proportion of your overall revenue. That's something that historically we've just taken the view that you cannot mitigate that risk. High churn, customers churning out frequently is problematic. In terms of how the KPIs have evolved, I think the core things we value have not changed. This is good growth, good capital efficiency, and all the metrics around customers really liking and valuing the product. Clearly, there's lots of nuance. We have a dashboard that each of our companies completes, which is very detailed around all the metrics that you'd want to You'd want to dig into, your customer lifetime value, your customer acquisition cost, all that sort of stuff. But these are just really granular ways of determining return on investment. If I'm going to invest, 10, 20, $30 million, dollars in a company, how is the company going to grow? How is sales going to expand and perform, beyond that? Usage measures. I guess what I'm saying is there are a lot of detailed metrics that we look at, we track, we evaluate, but the top level ones are the same, which is growth, efficiency, and customers really valuing the product.
So you said growth. We talk more and more about sustainable growth versus a rapid scaling, and there is more and more a shift, of course, in the industry and across all industries. Do you think that this shift has an impact on your investment strategy and the way you approach entrepreneurs?
I mean, so probably you saw this the most in the sort of 2019 to 2021 period, where you had, a combination of low interest rates, COVID, meant that there was just really a kind of massive inflow into software companies, and companies had this kind of growth at all costs model. As mentioned, we've been doing this for over 25 years. We have a very consistent model, which is about investing in, sensible growth stories. We're not chasing kind of a unicorn type return. We want all of our companies to be successful. We really hate losing money on deals, and so we're targeting a 3x plus return when we invest, but we're not targeting a 20x, 30x type investment, and taking the type of risk that you have where you have failures. So we really observed this phenomenon over the last few years of just growth at all costs. We're very fortunate that we did not participate in it. We remained very disciplined, and you had a very swift kind of reversion from the investors to a kind of a profitability type focus. So you're seeing companies, funds evaluating small businesses and looking at their profitability metrics. I think for us the key point is growth is the number one driver of return. Profitability isn't. So if you're investing in €10 million SaaS company that's going to stay at 10 million for 3 years, but you're going to grow EBITDA from 1 to 3, that is deeply uninteresting. On the other hand, if you're going to try and grow from 10 to 100 and burn 100, that's deeply uninteresting also. So what we want to do is we want to grow these businesses at a good clip in a very efficient way. And it's not about specifically generating cash flow, but it's about investing sensibly and sustainably. So really understanding the relationship between how much I'm investing in sales and marketing and what the payback is. And if those metrics are really good, I'm going to invest more because it's economically rational, to do that. But we're not, speculatively investing and allowing the losses to pile up like the sort of the traditional VC model does.
Makes sense. Okay, Hillel, we have just a little bit of time left. This is a topic that I've been discussing with Johnny, so I'm happy to dive with you today about the AI and its impact also on your organization. And I would say not AI, but more tech. So what are the different tools that you, years after years, implemented within your organization to improve your daily operations, to also be more efficient with regard to the deal flow management? Can you elaborate a little bit on this?
Sure. So, the key to our strategy is we don't want to be investing in competitive auction processes where, we're receiving beautiful presentations and being the highest payer in a bank process. And so over the last, 10 years plus, we developed a process which we call the predictive model, which is a way whereby we leverage technology to collect data on hundreds of thousands of companies. We use analytics and algorithms to determine which of these companies are the most interesting, and we focus on proactively outreaching to those companies. And technology has played a part, throughout the journey in this. And we're now using AI, we're using generative AI to do this. And I think what we've seen is this has really given us quite a good bump in efficiency. So it's not really changing what we're doing, which is really collecting data on hundreds of thousands of companies and scoring them and figuring out which ones are the most interesting. But it's enabling us to do that in the sort of 30 to 40%, more efficiency way. I think there's lots more you can do. I think there's a balance between becoming, sort of too dependent on AI. So I'm sure you notice when you get emails that are AI generated, I think, we're trying to continue to be relationship driven, personalized, focus on trying to build relationships with companies. And so we're not really using it in our communication style, but just in terms of leveraging AI to collect more and more data information on the companies that we think are interesting, I think is something that we find valuable. And then, just to say on the investment judgment side, this is not an area where we're using AI. Our view is that, the benefit of AI is sort of putting the data together, and ultimately, we need to apply our own judgment on whether this is something that we want to invest in.
Good to hear that. Yeah. So this is something that you built internally. Did you recruit some engineers, or did you buy potentially some tools?
No, we built it. We're very fortunate to have amazing team members who are extremely capable and have learned and developed. The system, as I say, has evolved over time. But it's a kind of our own tool that we use. And I think if you want to be investing in bootstrap companies, you have two challenges. The first one is finding the most interesting companies out there that are not looking for capital, and so you have to be smart on sourcing. And the second is convincing them to work with you. And so the relationship management side of it is really key. So those are the things that we spend every day working on improving.
Perfect. So what are your next steps at Kennet Partners?
So I mean, we're really excited about what we're seeing in the market at the moment. We don't want to change too much. We continue to focus on bootstrap B2B SaaS companies. We're excited about the ability for AI to really increase the market size of our existing portfolio and potential new portfolio companies. We're excited about what we're seeing in Europe and the UK. And the ability to expand these companies into the US market. So it's a continuation of what we've been doing over the last 25 years, just hopefully doing it a bit better each year.
Perfect. Congrats for what you did. Hillel, my conclusion is always a book or a podcast or a recommendation for the listeners. So what do you recommend to us today?
So in terms of books, this is quite a tough question to narrow it down to one book. I feel like there's a lot that I want to talk about, but I think the one that I think is most relevant maybe to kind of business and scaling is the book Shoe Dog, which is the book by Phil Knight. The story of Nike. Just I sort of see that as like the ultimate entrepreneurial story, encompassing every aspect of kind of vision, challenge, operation, politics, all that kind of stuff. So anyone who has not read that, I would strongly encourage them to read that. And then, in terms of podcasts, I love listening to podcasts. Things like Acquired is a great podcast. Deeply goes into business building. The podcast Founders,
of course,
you heard that. Another really good one. Huberman Lab in terms of science and biology.
But it's a long one.
It's just a kind of great.
Huberman Lab. It's like you need to go for a big run.
Yeah, exactly. It's good if you're like traveling through an airport and flying, and you've got 3 hours to kill. It's called Invest Like the Best with Patrick O'Shaughnessy, another really good one. We can do a separate talk on podcasts. I'm very passionate about it. No, goes without saying.
Okay, thank you very much, Hillel. That was very nice. Thank you for your time.
Great to talk to you. Thank you for having me. Have a great day. Bye-bye.
Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.